There's lots of questions on your mind right now. Is the stock market overvalued? What's driving the market? Are we going to get another stimulus plan? And what's going to happen once November 3rd is over? Hey, it's Dean Barber, CEO of Barber Financial Group. I'm going to address all of those questions on this month's Economic Update. Stay tuned. All right, well, they called it the September swoon, and September actually ended a little bit better than it started. Most major indices are well off the highs of the end of August. Let's take a quick look here, just review what the markets have done in the month of September. And so you had every single major index in negative territory. The worst performing index, negative almost 8%, that's the NASDAQ. The best performing is the equal weight S&P 500 index, and kind of in the middle of the road, the Russell 1000, S&P 500 down 5.74%. So we had negativity across the board. Even the Dow Jones Industrial Average down 4.31%. But if I switch that over to a 3-month performance, let's take a look at that. Now, what do we got? We got NASDAQ, who was the worst performer for the month, actually up the most in the last 3 months, up 7.54% for the quarter, which is a great quarter, no question about it. And take a look at the 6 months, 37.38. Now, of course, that's to be expected because we're coming off the March lows. 1 year, or let's go to year to date. Year to date's pretty fascinating because remember I've been talking to you in the last few economic updates about the disparity in returns and where those returns are actually coming from. So if you look at year to date, you've got one outlier here, and that's the NASDAQ composite, up almost 30% for the year, even after losing 8% in the month of September, followed by the S&P 100, the Russell 1000, and the S&P 500 up 3.27% year to date. But come down here, you got small cap and mid cap down 16 and 10%. So when you think about what's going on in the market, there is this disparity between what's happening. I want to show you why. If we take a look at the market concentration, this comes from Goldman Sachs, and this is showing you the market capitalization on the top 5 stocks. It's also showing the past recessions, and it's showing the past bear markets. So let's go back here into 1999. The top 5 stocks in the S&P 500, they made up 18% of the total S&P 500. Today, the top 5 stocks make up 24% of the weight of the S&P 500. So the value of the top 5 stocks is 24% of the S&P 500. That is a huge deal. Let's scroll down here a little bit, and I want to show you what the performance of those top 5 stocks have been versus the other 495 companies. So remember, I showed you that the S&P 500 was up about 3% year to date. That's this blue line here in the middle. But the top 5 stocks are actually up 37%, while the other 495 stocks are down by 4%. So even though they're making up a large weight of it, that's not what's happening. A lot of those top 5 stocks like Google, Facebook, and the like, Amazon, Tesla, those stocks have all been on fire. And we wrote an article here a little over a month ago, maybe it was 6 weeks ago, asking the question, is the stock market overvalued? You can find that article on our website, barberfinancialgroup.com. And you read this thing because we went into a ton of detail about the stock market being overvalued. The answer today is still the same thing. The stock market is still overvalued. However, a lot of the signals right now are saying what's happened in the month of September has the stock market oversold. And then that brings us to the idea of more stimulus and the election. Secretary Mnuchin said this week that he thought that the Congress and the president would work very hard to get another stimulus plan in place before the election. That sent the market on a rally. And we had the most awful debate that I've ever seen. And people are asking, okay, what's going to happen? Am I better off with a Biden presidency? Am I better off with a Trump presidency? And so I've got a couple of charts here that I'm going to go over with you. And I want to leave politics completely out of this. And I just want to look at the data and what happens typically under a Republican president versus a Democratic president, and explore how it works if you've got a unified House and Senate, or if you've got a split Congress. In this particular instance, we're going to look here at a unified government. Okay, so that means we've got House and then we've got a Democrat president or Republican president. So with a unified government, we're seeing a better performance in the market of a Republican president. However, if we've got a unified Congress, okay, here, and we got a Democrat versus Republican, you can see here that the Democrat is better than the Republican. If we've got a split Congress, Democrat versus Republican. So the stock market in most cases doesn't care who is president. The stock market is driven by GDP. 70% of our gross domestic product is consumer spending. So as the consumer goes, so goes the economy. The larger threat to our economy and to the market itself is not the election. It is COVID-19. And it is coming up with a vaccine so that people can get back to their normal lives, and the planes can start flying in mass again, and they can fill them to capacity, and people will get on cruise ships again. If COVID-19 hangs on another 3, 4, 5, 6 months without any meaningful progress towards a vaccine, I believe that you see a significant pullback in the market, and I think it's going to be far more significant than whether or not Joe Biden wins or whether Donald Trump wins. Another chart I want to show you here, what happens in contested elections. Okay, there's already been talk that we're not going to know who's president on November 3rd. Maybe not November 4th, maybe not November 5th, maybe not even by Thanksgiving. And there is a lot of politicking going on both sides of the aisle. So I want to take you back to 2000 when we had the contested election, and remember the hanging chads in Florida and all that was going on. Well, let's look at what happened. So you had the election day here on November 7th, right? And then what happens? We don't know who's president. We go into this whole idea that we just don't know how the vote. We're going to recount Florida. All of a sudden, the Supreme Court made its decision out here on December 4th. I don't know if you remember that or not, but we were over a month away from the election before we knew who was going to be sworn in the next year. And the stock market during that period of time, as you can see here, was down, 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 down. And then once we knew, okay, now the market gets a chance to go back up. Well, what did extremely well in that period was this orange line here, which is what? It's bonds, okay? So if we wind up with a contested election, it may be a good idea to overweight a little bit in bonds for a period of time until we really know what's going on. The drawdowns, they weren't horrible. The Russell 2000 lost about 7% right there, and the S&P 500 lost about 5%. Make no mistake, we expect volatility will continue to be with us for the next couple of months. And I really think that the main driver of what's going to tell us the direction of our economy and therefore the markets is going to be the progress that we make on a vaccine for COVID-19. We'll keep you informed, and as always, we are here watching over your accounts, and we encourage you to call with any questions. Thanks for joining me. Thanks for watching us on YouTube. Give us a thumbs up, make sure you subscribe, and share this with your friends.